Do you want to hear from one of the top real estate analysts in the US? Stay tuned. Well, that's right. We are back with NoteSchool TV, and you don't have to take our word for it, right? We brought on another expert to really help you better understand what is going on in what seems to be the craziest real estate market. So hopefully today we're going to chime in with some really great information to help you better understand how you could participate in the market and ultimately grow your wealth. So if you're new to NoteSchool TV, maybe you're brand new, maybe you've never been here before, we'll just say hello. It's always nice to see everybody jumping on and communicate. That's the beautiful part about a live show. I'll say hello to Edwin. He's out from Odessa, Texas. Thanks for saying hi. Glad you're here. It's always good to have everybody jump on NoteSchool TV. We are here every Wednesday live at 11:05 Central Time. And if these videos are valuable, we try to bring the best of the best to this channel to be able to equip you with as much knowledge as we possibly can. Hey, like these videos if they're valuable. And also just take that link and you can share it with friends and that kind of stuff. But definitely make sure you're subscribing to the channel. This is going to allow you to get updates on the more information or the new videos we put out, right? And probably the best way to participate in NoteSchool TV, the show itself, is to click that bell notification. It will allow you to be like getting alert on your phone saying, hey, they're going live, which tells you I should jump on, I should participate. It's always great to see. We got people from Brooklyn, from Colorado, from Texas, all over the place. Super cool. So I'm glad you guys are here. We've got a great show. And if you're brand new to Notes, and maybe you're even brand new to NoteSchool and you're trying to figure out really what direction to go here, you just need some more information, you can always go to noteschool.com/TV to learn a little bit more about really what this looks like, right? And after the show, you could definitely stick around because we always have an after party where we hang out with our guests a little bit more and we just kind of casually talk about your questions and your comments and kind of what's going on in your world, right? It's just a way to engage a little bit more with you and participate. So before we get into this, right, again, make sure you're commenting and chiming in. We'd love to hear from you. As this goes on, we've got some really great stuff we're going to talk about. If you've got questions, type them in the comment box so that we can actually bring them up. We can actually talk about it, and we'll go from there. So before we bring on our guest for today, we got to talk about the latest in the news, right? So I'm going to bring on my friend Joe, and let's talk about some news issues. Well, hello, Joe. How you doing?
Well, I am great, Brian. How?
I am doing quite well.
Good. It's good to be here. And guys, we have an amazing guest today, and we'll bring him on in just a minute. But we have a couple of news blurbs there. So let me just kind of run with these. I don't know if we got to share those today on the screen. I don't know what happened there, but here's what we have. We have the U.S., obviously, is existing home prices hit a record high in May, Brian, hit a record high. So what that really means is that the median existing home price in the United States topped $350,000 in May. For the first time, the National Association of Realtors said, right? So this figure was nearly 24% higher than it was this time last year.
Yeah.
24%, Brian.
It's amazing.
It is amazing. So that is one piece. And then the second piece on the news today is about down payments, right?
Okay.
So about 40%, actually about 40% of the folks that bought last month in April had to put more than 20% down when they bought a property, right?
Yeah.
So the programs out there. So what that means, and we're going to talk more with our guest about this in just a few minutes. But really, what that means is the programs that are, the Ginnie Mae programs, which would be FHA and VA, the low down payment programs, the 5% down program. Those folks just aren't having luck because with multiple offers going in on properties, if you're not, approved, pre-approved, if you don't, they don't think you have the money to move forward, they are not going to accept your offer, no matter what you're doing when you've got a really low down payment loan, because those typically don't have a high percentage rate of closing. So amazing stuff, again, going on in the world. We know, as we talk about every week on NoteSchool TV, that real estate is on fire, right?
That's right.
There's that side of the market. And then obviously there is the other side of the market where, there are a lot of underlying challenges there today. So that is that. And guys, Brian, let's introduce our guest today. So our guest today is Daren Blomquist, and Daren is, he's the vice president of market economics at auction.com. And I'll tell you, guys, he is the man, right? His reports and analysis have been cited in thousands of media outlets, Wall Street Journal, New York Times, CBS, ABC, CNN, CNBC, Fox, all over the place. So let's welcome.
Hello.
All right. Good morning. How are you, sir?
I'm doing well.
Very good. So, Daren, thanks so much for being with us today. And so you're in California, so it's bright and early out there still. So I'm in Florida, so it's after lunch here. It's lunchtime here now. So anyway, we're glad to have you. So tell us a little bit about what you've been doing. I know you and I talked earlier. You were with Realty Track for 17 years, right?
Mm-hmm.
And
Realty Track started there in 2001, and I didn't, it was a startup at that time. Didn't know what I was getting into in many ways, but it was a fun ride for us going through. But one thing I think about is that 2001 today feels a little bit like 2001, 2002. Mm-hmm. A lot of people try to make a comparison to now to maybe more like 2006, 7, 8. I actually think it feels a little bit more like those early days of Realty Track when, so Realty Track specialized in bringing foreclosure data online, which it had never been before. And we were growing like crazy. Even though there were very few foreclosures, our subscriptions were growing like crazy because there were a lot of folks interested in investing in this, real estate market that was on fire, as you said, back then. And so anyway, we saw that rise up, and then we started issuing reports on the foreclosure market in about 2005.
Right.
And we started to see these crazy numbers, like the foreclosures are going skyrocketing all of a sudden. And that was more like 2006. We started reporting on that. We got accused of being, sensational and sensationalizing it. And we got people like, other groups that have been around for a long time saying, there were quotes like, we're just coming in for a soft landing in this real estate market. And, the foreclosure numbers are not as bad as you're saying. And, but then it turned out, for better or for worse, that we were right. I don't even think we realized how right we were when we saw those foreclosure numbers spiking and happened to be reporting on it at the time, we were just reporting on it because we were like, nobody else is talking about foreclosures. So at least at a nationwide level. So anyway, that's maybe more background that you wanted, but I think it ties in.
No, I love that. And our audience loves that as well.
I think it does tie in. It parallels in some ways to what we're seeing today. Is I would say when you see 24% increases in home prices that you just mentioned, a lot of people still want to say we're not in a bubble, and maybe we're not in a bubble in the same way that we saw a housing bubble last time. There are many different aspects to it, but we're in a market that is starting to behave a little bit irrationally. And so that spells changes coming ahead, I think. And not even as a result of the pandemic, but as a result of the response to the pandemic. And all the stimulus that is creating this market frenzy that we're seeing.
We kind of jokingly refer to it, and I know some of the publications out there refer to it the same way, and it's FOMO, right? It's fear of missing out. And we had a news story last week with some of the folks that just jumped in and said, I got to get in, even 6 or 8 months ago, or certainly now regretting it, even with prices still going up, and so you're doing it at auction.com because you're. So what is that? What do you guys do, and what does that really mean?
Yeah, well, we specialize in selling distressed properties on our platform, which hopefully is of interest to many in your audience. And we actually participate in the sale in terms of, there are transactions that are happening online on our platform, online auctions. So kind of think the eBay of real estate. So we have a large portion of our sales are happening where you can go online right now, start bidding on a property, and potentially win that property just by bidding online. And then we also do a large portion of the courthouse foreclosure sales across the country. And those are historically the in-person sales that you would go to at the courthouse steps.
Right.
And sometimes they're called sheriff sales or trustee sales, depending on the state. And they're required by law. The lender has to go through that. But we are crying those auctions, and those properties are on our site, but then physically you would go to the auction. Now, I do want to mention we have a new remote bid feature on our app where you can, in some counties now, and some properties, you can bid on those auctions that are happening on the courthouse steps from your phone, which we think is amazing. But anyway, we sell these distressed properties, these foreclosure properties through an auction method. And we have a ton of data. We estimate we make up close to 50% of that foreclosure sale market. So we have a ton of data beyond just the public record data that I had access to at Realty Track and Adam, which was great data. But beyond that, we have our operational data that tells us how much, and we can get into that a little bit, how many people are buying at the auction, the sales rate, which is an important metric of demand, and how much they're bidding relative to the lender's credit bid, which is the amount that the lender is owed on the property. So a lot of good stuff that I get to play around with in terms of data that also, I think, help in some ways. The folks who are bidding on our platform, they're the real estate investors who are on the front lines of the market, and they are leading the market. So some of the trends that we see in our data often lead what we see happen in the larger retail market down the road.
Right. So we were talking earlier, and I know you and Eddie were talking a couple of weeks ago about kind of how you guys have kind of affected the market as far as with third parties at the auctions, banks not so much taking properties, but third parties. Talk a little bit about that.
Yeah, absolutely. I mean, when we got in, we started as a company back in, I think, close to 2000, around that time frame. I wasn't here, obviously, but doing the bank-owned auctions, the properties that had already been foreclosed. But then about in the last decade, we got into doing the foreclosure sales, and we really changed the thinking of banks, because banks thought of those courthouse steps auctions as just a checkbox that they had to get through.
Okay.
And they assumed that most of the time they were going to end up taking back that property at the auction rather than actually selling it to somebody at that auction. You know, it wasn't really an auction. It was just a checkbox to repossess the property. And we changed the thinking by really making that auction a true marketplace, where we put up pictures of the properties, and we typically hold those, even though they're traditionally like just on the courthouse steps. If you went to a foreclosure auction back in, say, 2005, what you would see, you wouldn't even know it was happening. You would go to the courthouse steps. You might see a group of like half a dozen, middle-aged white men, no offense to the two of us, but standing around and in shorts and t-shirts, some guy with a computer, and you wouldn't even know it was happening. We've created a marketplace where we're advertising these properties, promoting them. And what that means is we get a lot more demand. And for the banks, it means they can actually sell those properties much of the time at the auction and sell them for a price that makes sense for their bottom line. It actually they get enough back on their loan, or they completely pay off their loan that's owed, the amount owed to them at the auction, because of that demand that's coming to the auction marketplace. And so we're seeing the sales rate is a key component we look at. When I look at public record data prior to auction.com coming into the mix, we were seeing, if you got 20% sales rate at the auction, meaning of the properties that go to the foreclosure auction, 20% of them sell, that was good. But in recent years, we had doubled that, and it was closer to 40% leading into the pandemic. Now, what's been crazy is that during the pandemic, that sales rate has just hockey sticked, like a lot of other trends that we see in the pandemic, which have been somewhat surprising. And we are seeing sales rates now over 60%. Now, part of that is, so in other words, 6 out of 10 properties that come to the auction sell, which is unheard of compared to the last recession. And in the market, when we compare that to the market, it's still in the marketplace, we're still seeing more like 25 to 30% of a sales rate. So when the properties are not promoted, you see much less demand. And anyway, so yeah.
And I was just going to say, Daren, contrary to popular belief, I think most people think that banks really would prefer to have the property, but they're not in the property business, right?
Correct. I mean, some of them have thought that they should get into the property business. We've tried to convince them that's not what they should do. And we see in the data that if they take the property back and rehab it and resell it, they actually are worse off than if they sell it to an investor, especially a local investor. The local investors are much more efficient at rehabbing, right, and getting that property back to the retail market faster than the bank. So yeah, they've realized that foreclosure auction is actually an opportunity to improve their bottom line by selling it to a third party.
Versus what we saw back, in the Great Recession back in 07, 08, was that we're not seeing underwater properties, right? We're seeing there's properties with a tremendous amount of equity in it, trillions of dollars in equity growth over the last, year or so. So, that's the other part of that, right?
Yeah, that's absolutely true. And we see now most properties that come to foreclosure auction, at least at least in theory, there's no equity. Otherwise, they probably would have sold, or at least the homeowner thinks there's no equity, and the bank think there's no equity.
Mm-hmm.
Now, our marketplace a lot of times is proving them wrong and saying, hey, there's actually equity here.
Right.
Because the bidders come in and bid up the price above what's owed. In fact, we have a metric we call price execution, which is the winning bid at auction as a percentage of the amount owed on the property.
Right.
And that is, over the last couple of years, that's been averaging 115%. So they're selling on average for 15% above what is owed, which indicates equity. And the great thing in that situation is the homeowner is losing the home and having a foreclosure on the record. So that's not great, obviously, but any what's called surplus funds above what's owed on the property can go back to that distressed homeowner. So they do benefit from that equity. But yeah, that's a big difference in today's market. And I think the reason that even if the foreclosure moratorium were lifted at the end of this month as it's scheduled to, we'll see if that happens or not. I think we're not going to see a flood of foreclosures because many people have the ability to sell. Now, we may see a flood of distressed inventory at the pre-foreclosure, and maybe flood is too strong a word, but we may see pretty strong uptick in distressed properties for sale. Homeowners who say, I had 18 months of protection from foreclosure, but now I've got to sell because I haven't got my job back, or I haven't got as good of a job back, and so I do need to sell. So we may see that more so than even a flood of foreclosures when the moratorium lifts.
Yeah, we kind of talk about, okay, so it's not going to be a tidal wave, probably not a tsunami, in here, which I'm going to ask you to kind of take out your crystal ball, and say, okay, what is the rest of 2021 going to look like? I mean, as far as, when is supply going to catch up with demand and that kind of thing as well? I'm really going to put you on the spot here, right?
Yeah, a couple things I want to point out. I've never understood, is a tsunami or a tidal wave bigger or what? But it's going to be more of a rising tide, I think, of in terms of foreclosure inventory, and I think the overall market will see a rising tide of inventory too. I think if you look at some of the data in the NAR report you cited earlier, we now have seen 3 months of rising inventory. It's still below year-ago levels, but it is gradually rising. So, but on the distressed property side, one common misconception is because of the foreclosure moratorium, there are no foreclosures happening.
Right.
We're still doing foreclosures through our platform. It's at a much reduced level than it was a year ago. We've been hovering over the past few months at about 30% of pre-pandemic levels, meaning 70% below pre-pandemic levels, but they still are happening. And so there's still inventory available that people may not realize and you can find. But we've done a long range forecast looking at as many factors as we can think of. And we see 2021 being actually at about 2020 levels, which was, again, probably around 20 to 30% of pre-pandemic levels. We do see, starting in 2022, the numbers rising more dramatically, but it's not until 23 and 24 that we expect to see foreclosure numbers return above pre-pandemic levels. And I would say there is a backlog of foreclosures. I mean, despite what I said earlier, the moratorium is a blanket moratorium, and so it's applying to a wide range of properties, and it's stopping foreclosures that would have happened even in a healthy housing market. And so that backlog of foreclosures that kind of would have happened,
right,
is, even if you don't have any pandemic related foreclosures, we're going to see those come through over the next few years and provide more inventory in the market.
So yeah, and we don't mean this in a negative way to anyone, but we're going there's going to be a lot of adjustments made there, and there is going to be some opportunities for investors, right? That know what they're doing, and that can buy those those types of properties. And of course, we talk about buying non-performing notes, just as now we stopped talking about it for 4 years, right? And now at Note School, we talk about that, and we work with a Revolve Capital, Chaz Gwynn, and his group, and through our platform, which is Notes Direct, and we're starting to add more and more non-performing assets on there as well. But it's interesting, I had that thought that it would probably be this kind of thing keeps kind of getting pushed down the road and pushed down the road. And, you said 2022 and then 23 and 24. So it's certainly going to be an interesting few years, right?
It is. Yeah. And I think it's a good point that a lot of these, just to put some numbers on this, there are 2 million properties in forbearance is one way of looking at it. That's a big pile of risk that's sitting out there in the market. Mm-hmm. 2 million, and pre-pandemic. Well, and then actually the more pertinent pile of risk, the number that we look at is seriously delinquent loans, which are now at about 1.9 million. If you include seriously delinquent and foreclosure. So it's a little bit smaller number, but that's still in excess of about I would say about 1.3 to 1.4 million more than what we saw during the pandemic or before the pandemic.
Right.
That were seriously delinquent. So something has to do with this mountain of risk. Now, like I said, a lot of those, because of equity, are not going to go to foreclosure, but there will be more pre-foreclosure sales. There will be more note sales. I think those, the lenders and the government agencies selling off that risk so they don't have to deal with it. And yeah, so there is that opportunity. And then I would say, I alluded to this earlier, but I think right now, I'm not as worried about the risk created by the pandemic as I am about the risk that's coming because of the response to the pandemic, right, which has been to create this overheated housing market. At least in part, I can't blame it all on the response to the pandemic, but all the stimulus, all the efforts by the Fed to save the market have done more than save it. They've created a market frenzy, and that could, again, if we go back to 2001, 2001, there was a recession, a very short recession, and interest rates were very low. Mortgage rates were dropped by the Fed to help stimulate the market, to save the housing market. And it did. The housing market didn't really drop after the 2001 recession, but it created a bigger bubble to be popped for when the 2008 recession started. So that's a little bit of a tangent, but
well, we kind of call that at Note School. We call that the crash that was in slow motion, right? It was kind of it just kind of built, and then finally in 2008 it went.
Yes.
Yeah.
Hey Joe, I did notice a question from John about one of the statistics I put out there, the 115%. So I don't know if I'm out of line to hit that, but I did want to clarify that for him. He asked if that's legal balance or unpaid balance, and that is unpaid principal balance.
Unpaid principal balance, yeah.
So that is I think by legal balance he's referring to the total amount that the lender could recover.
Right, that is correct.
And that it is that legal balance. It includes the unpaid principal balance plus any fees or interest that can be included in the credit bid for the lender at the foreclosure auction. Right. Now, what it does not include is if there are junior liens on the property.
Right.
So, if the 115%, say the property has a legal balance of $100,000, we sell it for $115,000 on our platform. That extra $15,000, if there are any junior lien holders, that would go to pay them off first.
Right.
And then would go to if there are no junior lien holders, or if it pays them off and there's still excess funds, that would then go to the distressed homeowner.
Correct. And we'll take more questions, guys, in the after party. One final question, Daren, before we kind of go, and then we'll go into the after party and we'll talk more about this. What should an investor do? What should a real estate investor do right now, to make sure that they're kind of going based on all of the knowledge and everything that you have? What should we be doing right now? Note investors, property investors.
Yeah, I think it is a little bit more tricky time to acquire properties, for sure, because it's harder to find the discounts out there. And on the note side, I'm not as familiar with that, but I do think that the investors should be keeping powder dry for the opportunity coming. And it sounds like you've heard that phrase before.
Well, yeah, that's a big Eddieism too. Keep your powder dry. Yeah.
It must have rubbed off on me, but I do think there is opportunity right now. I mean, I think there's a now and not yet to this opportunity. And so the now opportunity is, there are opportunities to buy. There's always opportunities to buy, depending on your situation as an investor. From the property side, what I see in our platform is follow the demographics. People are moving out of California, where I am. I feel like I'm the last one left here. But if you look at this census data, people are moving to, the Sun Belt, and they're moving to the Southeast. They're even moving to the Northwest inland. Don't think Seattle, think Spokane and places like that. And
Boise, places. Yeah.
So find the distressed opportunities in those markets, and take advantage of those demographic trends and the affordability trends. So people, in my mind, are chasing affordability when it comes to housing, as well as other, taxes and all that. And so follow those trends and find the distressed opportunities in those types of markets. Is the more of the now opportunity. The not yet opportunity is a little bit harder to define, but we do see signs that there will be more opportunity down the road as the foreclosure moratorium are lifted eventually, and the forbearance programs expire. Right. And then beyond that, possibly when a bigger bubble is popped by the next recession.
Got it. All right, Daren, thanks so much. Stick around. We're going to go into the after party. I'm going to bring Brian on, and Brian is going to talk about how to, get more information about Note School. And he is going to talk about our sponsor. Hey, Brian. All right, Brian is going to talk about.
There we go. I'm back. Yeah, absolutely. Before I jump into that, man, I think this is really, really great information. And I see a lot of people are typing in the chat and stuff. So bring your question. If you got questions, or you got comments, or you got ideas that you want to talk about with Daren in the after party, start typing them in now, because we're going to start heading that direction. But of course, before we do, we've got to talk about our sponsor, who is Notes Direct and the Feeding Frenzy Friday. Well, each week, Notes Direct is always pushing out more and more opportunities for you to buy notes and be able to buy a note as easy as you buy something on Amazon by simply doing your due diligence and then clicking that buy button. But each week, we actually take a note from Notes Direct and we put it on our playlist called Feeding Frenzy Friday. And you can go check out these episodes at noteschool.com/FFF. But we're just taking a note and we're breaking down the details of it to help you better master your level of due diligence and better help understand maybe if this is going to be for you or not, so you can figure out if you should go take action, right? And so it's a really cool opportunity. Go check that playlist out. And again, if you're pressing subscribe to the channel and then clicking the bell notification, you'll actually get it a day earlier than if you just go and check it out later, right? And so, as I mentioned before, hey, if these are valuable videos, man, if you loved having Daren on, man, hit like on the videos. It tells us that kind of what, when we go back and look at this stuff, what videos we need to bring more of. Subscribe to the channel. Like I said, hit that bell to be able to be notified specifically for NoteSchool TV, because we do go live every Wednesday at 11:05. Central Time. This link right here on the screen, as always, is going to be a great opportunity if you are looking to learn more about notes or know more about NoteSchool and what your next step is, and you're just trying to figure out what that looks like. Go to noteschool.com/TV, or you can always go to the NoteSchool webpage, noteschool.com, and there's a Contact Us tab, and if you click that, you can reach out to us there. Maybe you just got some burning business desire. You've got to get that problem solved immediately. I need help now. That's fine. Go ahead and reach out. So, as always, it's been fantastic to have you joining us. Next week, we've got a very, very important market industry update from our one and only fearless leader, Eddie Speed. So join us live next week. Well, for those of you who cannot stay, oh, I'm so sad. I'll see you guys next week. But for those of you who can stick around for the after party, we'll see you on the other side. Well, Daren, thank you so much for jumping in and hanging out with us today. I know we had a lot of people jumping on from, golly, all over the place, literally, and including our own backyard, Dallas, Texas, in the house. And so, man, really appreciate you. I know that there was some comments earlier being made about kind of even what some of the news was talking about, Joe. Where it's like, man, these houses are being sold for, and more people are putting more and more money down. You know, something we didn't even talk about was this appraisal guarantee you're seeing on offers, right? Because it's not going to appraise. And so people are forced to put more of their own money into the property in order to be able to get it. And so this is another symptom of, or I'd say another element, variable in the why our down payments going up. I think that's important. And I think it's also important to mention that there's a little bit of misunderstanding, I think, in the market of like the pandemic, and the fact that there's fear and all this kind of stuff. People think, look, I know that a lot of people are hurting right now. I would never discredit that in any way, but I'm saying that as investors, you can't have the mindset of some people are hurting, so therefore nobody's got any money to spend, right? Like, it's not that kind of an economy. People have a lot of money to spend, and they're willing to put down excessive amounts, as you see. So it's really, really good stuff. Well, cool. Joe, you're muted, Joe.
Are you guys tracking that metric as far as, you've got a house that they were asking $400,000 and goes for it finally gets under contract for $475, and okay, it's appraising for $425. The guy's putting 20% down, but it's $50,000 over appraisal. So now they've got to put down the 20% plus another 50. Do you guys have a metric for that as well? Or are you tracking that?
Yeah, the parallel metric, I would say, in our data, that's again, I think often leads the market, because the investors are telling us what they think is going to happen in 6 months. Is that I was just looking at this morning? It's the price execution. I mentioned it earlier. There's price execution relative to the unpaid balance on the loan, or the legal balance. But there's price execution relative to the estimated value of the home. And on our platform, before the pandemic, we were seeing that average about 79%. So in other words, people were paying 79%. And that's not after repair value, by the way. It's the actual estimated current value of the home. The bank says, we think this home is worth $100,000. We sell it on average for $79,000. So the investor is getting a great discount, right? But what's been kind of crazy is on our side, that I think parallels that metric, is that percentage has now gone up. I was just looking in May, it was up to 92%. So instead of paying 79 cents on the dollar, our investors are now willing to pay 92 cents on the dollar for a distressed property. And, that's good for the sellers. But the investors are also doing their calculus and saying, I talked to one the other day who says, because on the selling side of this crazy market, I made $30,000 more on my flip than I thought I was going to make because prices have gone up so fast. And actually, I can share some of my slides too if you want to show some of this. But I was just looking at home flipping and our average. So we looked at properties that sold on our platform and then were resold by the investor within the next year. Mm-hmm. And this is over the past couple of years, but this has actually been going up, is the average gross flip profit, which is just the difference between what the property was purchased for and what it sold for, is now $92,000. And that's 58% gross ROI, meaning, that $92,000 is a 58% return on the purchase price. Right. I do want to be clear that's not taking into account rehab costs because we don't know that.
Right.
But that number is pretty incredible. And I was actually comparing that to public record data on home flips, and the home flips, the profits are going down just in the last couple of months because the many home flippers are having trouble finding the discounts on the front end. At least on our platform, there's still some, even though it's 92 cents on the dollar, it's still a better discount than you can get if you buy retail. And so that's why we see our buyers, their flipping profits are going up. But around that question,
Daren, a couple of things there. Number one, you've got pricing on lumber, of course, is way up. Mm-hmm. Finding labor to do the rehabs is an absolute bear at this point. I'm having some rehab done on my house right now, and same thing. And but I was looking at something the other day, and it said 7% of actual home sales are actually flippers, where it was 2 years ago, it was probably almost 10%.
Yeah, that number has gone down. I'd be interested to see. What I'm hearing anecdotally is people are flipping not because they intended to flip. I'm hearing more stories of people who bought a house maybe near the beginning of the pandemic, and it's gone up so much in value. They're like, I'm going to sell, even though it's been maybe a year since I bought. Yeah. And I'm curious to start looking at the data to see if we see that trend emerge. And that's actually another sign of a irrational and potentially bubble forming market. We saw that kind of behavior in 2006-07, people not buying properties that are in good condition. They're not even adding a lot of value to them and then just ending up flipping them. So I'm going to be looking for that. But to your point, right now, it's harder to find the discount on the front end, and your costs are going up in the middle. So that's tough.
Right.
Yeah. I've always found that, and this is kind of the devil's advocate to the argument, is that in flipping conditions like this, it's very, you're speculating that it'll be worth more. Right. Like I just sold a home, and I knew if I waited one more week, I could probably get a little bit more. And if I waited one more week, but there's going to come a moment where that irrational behavior and the psychological level shifts. And the question is, if you're scaling a fix and flip business right now, basically counting on the speculative nature of the property values continuing to increase, you eventually are going to get caught. And that's what we saw a lot in 2007 and 8 is these home flippers who, I was flipping and building, 15 houses. It was amazing. And they would loan 100% the whole time. And then it seemed like overnight, it wasn't, but it seemed like overnight that all of a sudden prices aren't going up anymore. And now your margin disappeared because it was speculatory anyway. And this is, I think, the more risk averse piece of me that says, I'm not saying it doesn't work. I'm saying you got to at least entertain what happens when things do shift.
Absolutely. And I think one of the things that you were saying was, Daren was saying was that exact thing. And one of the things that we talk about with notes, especially non-performing notes that we're looking at on our platform, is that there are the ones that are there are really, really they've just set just a few months delinquent. And there's a lot of opportunities because of the equity to buy at a discount. And then most likely it's not going to end up in foreclosure. They're going to just sell it and you get paid off. So anyway, Brian, what kind of time do we have here, guys?
Hey, man, it's actually funny. I'm actually about to wrap us up because, Daren, I really appreciate you coming on. We are out of time for this week, but I hope everybody had a fantastic time learning some things. Keep the comments coming on YouTube, on Facebook, wherever you're watching, and bring your questions when you think of them later. We'll always circle back. We'll make sure we follow up with you and try to get you the best information we possibly can. Joe, you got it something?
I do. So we just need to make this about every 6 months we'll have you on. We'll get you on again before the end of the year, and we'll kind of see where what we talked about today, how that relates back in 6 months. So let's plan on that.
Oh, so you're going to hold me to my word? Is that what you're saying?
Listen, Daren, this is an opportunity. You're going to be a genius at the end of this thing. It'll be great for you. So, well, Daren, thanks again so much. Thanks to everybody else who jumped online from all over the country. It's always great to see you. We'll see you next Wednesday at 11:05 Central Time here on NoteSchool TV.